Hello everyone, welcome back to DHISHA Wealth. Today we are going to see a deep analysis on Axis Small Cap Fund. Fund returns since inception, it is 21.71%. Inception date is 5th November 2013. Minimum investment rupees 100, minimum SIP amount rupees 1000. And fund returns, it is always appropriate to compare the fund's returns with its benchmark, that is Nifty Small Cap 250 TRI and category average, small cap category average. Say the 10 years return, it is the fund has given 16.61%. Nifty Small Cap 250 TRI, the benchmark has given 13.04%. and the category average has given 15.23%. So in the 10 years, the fund has beaten the benchmark as well as category average. Say in 5 years, the fund has given 29.75%, the benchmark it is 34.28%, and category average it is 33.21%. In the 5 years tenure, it has underperformed. So my suggestion is, when you are comparing any fund or you are analyzing any fund, you have to take a long-term tenure, and when you see for the 10 years or 5 years, depending upon the fund, say the other tenure, if it is underperforming, then you need to give some time. You should not take a decision immediately to switch off from the fund and get into some other fund. What is the guarantee that new fund which you are going to switch will perform again? So based on the past performance, we are choosing the fund, and when we are continuing the fund, we need to do the funds analysis. Say portfolio, you got 5-6 funds or around 10 funds, whatever, how much of funds you have. Yearly once compulsorily you need to do a review. Say this fund in the 5 years term, it is underperforming the benchmark as well as category. Say then again we are rechecking it in 3-year period. In 3-year period, it has done comparatively better than the benchmark. Benchmark it is 13.83%. This fund has given 13.98%, though it is underperformed compared to the category. Category it is 14.69%. Say then 1 year return, if you see, the fund has given 4.37%, whereas index has given negative 5%, 5.6%. So here really this fund has done well in the last 1 year. Even the category has given 0.68%. The portfolio's top 10 holdings, you can have a view here, and these are all decided by the fund manager. Let's look into the sector allocation top 10. Financial services, they are holding around 18.73%, healthcare 11.66%, capital goods 11.41%, then chemicals, consumer durables, automobile and auto components, FMCG, IT, realty. Why falling less is important? Say in mutual funds, here we are seeing a diversified sectors, diversified stocks. So compared to a direct stock investment, the mutual funds fall less. Why falling less is important? You see, suppose in direct stock, if the direct stock goes by 50% down, in order to recover and reach the principal, reach the capital, the portfolio need to rise by nearly 100%. So it is always very important to fall less. While investing in mutual funds compared to a direct stocks, we tend to fall less. Then coming to asset allocation, equity 88.8%, debt 0.7%, cash they are holding 10.54%. The portfolio behavior ratios, when we check, Sharpe ratio it is 0.59, it's a good score. Alpha it has generated 1.2, beta 0.69, so it is good number. The beta should be less than 1. Standard deviation 14.69, Sortino ratio it is decimal 9. When we check the market cap distribution, large cap it is 3.89. It's a small cap fund, so small cap you can say it's around 65.49%, then rest is mid cap 17.37%. When we check the financial year basis standard performance as on 31st March 2025, say the 1 year, the scheme has delivered 10.98%. This is as on 31st March. And comparing to benchmark has given 6%. So compared to benchmark in 1 year period, it has really done well, though it was not doing well with the 3-year and 5-year period. So holding on to that fund, not switching out because of the underperformance in the few periods, few months, few tenure. It's always better to give some time and understand, do the research, do the analysis, and try to understand the fund manager style. See here, he has given a comeback. The fund has bounced back in 1-year period compared to benchmark 4% alpha. And while we look at the category average, it has given in 1 year 7.7%, whereas the Axis Small Cap Fund has really done well in the last 1 year. And let's look here how the scheme has recovered compared to benchmark in past times. So say the January 2014, the fund has fallen negative 4.03%. Comparing to benchmark has fallen by negative 7.32%, and the benchmark recovered in 56 days. This fund took 61 days. Then the second fall in 13th April 2015, the Axis Small Cap Fund has fallen by negative 8.9%, whereas the benchmark has given negative 10.91%. Benchmark recovered 113 days, and the fund has recovered in 107 days. And the next major fall has happened in 20 February 2020. The fund has given negative 34.3%, whereas the benchmark has given negative 42.15%. Benchmark took 208 days to recover, whereas the fund has recovered in 267 days. And in 18 January 2022, Axis Small Cap Fund has given negative 14.64%, whereas the benchmark has given negative 22.86%. The benchmark has taken 504 days for recovery, whereas the Axis Small Cap has really recovered fast. Comparatively, only 230 days it took. And the latest, it is 26 September 2024, Axis Small Cap has given a return of negative 19.59%, whereas the benchmark has given negative 25.65%, and we are yet to see the recovery phase. And next, very important to see any fund performance is the market capture ratio. So depending upon your investment tenure, investment horizon, choose the market tenure ratio. Say for a 3 years period. So minimum you need to consider 3 years. Better is 5 years, 7 years or 10 years. The longer tenure is better, depending upon your investment horizon too. So normally investors, when they come to the equity market, a minimum what we suggest is to be at least for a minimum of 3 years period. That is for generally for large cap funds. Whereas mid and small cap funds, we need to minimum should be 7 years or 10 years, that range. Okay, this particular fund in the market capture ratio, say up market capture ratio should be more than 100%. That is good, but this fund has given only 68%. And the down market capture ratio should be less than 100%. Yes, this has given 61%. So this is good number for a down market capture ratio. So overall total capture ratio, comparing up market and as well as a down market, it is 1.13. So more than 1 is a good number. Say from the last 10-year period, say from 2015 to 2025, the data is available here. This Axis Small Cap Fund in the year of 2015, it was in upper middle quartile ranking. Then 2016, 2017, it was bottom. 2018, 2019, again on top. 2020, 2021, lower middle. 2022, it was upper middle. 2023, bottom. 2024 lower middle, 2025 again top. So this chart clearly shows that few periods of underperformance, again the fund is bouncing back. So we need to like when we are choosing any funds in our portfolio, this quartile ranking basis also we need to have a comparison, and any underperformance period we should not take a decision to. As I mentioned earlier, we should not be planning or immediately hastily taking a decision to switch out from the fund. There are chances highly, like this fund example, it has bounced back when the time comes, because depending upon the fund manager's style of investing. See, every fund manager is having different styles of investing, say value style of investing or growth style of investing, blend style of investing, momentum, factor. So a lot of factors, a lot of styles of investing is there for the fund manager. When the time comes, or maybe sometimes the stock selection may go wrong, and as possible for every fund manager, though they are expert in their field, possibilities are there, but there are chances for them to take a corrective action, and giving them the right time, you can see the recovery phase for the fund too. Next, If suppose an investor does a monthly SIP of rupees 10,000, what is the SIP returns this particular scheme has delivered? Let's see, for 3 years, the investor would have invested rupees 3,60,000, and current value this fund has given is 4,38,000. It is XIRR 14.05%. Say in 5 years tenure, the investor would have invested 6 lakh rupees. The current value of the fund is 9,65,000, XIRR 19.7%. In 10-year period, the investor would have invested 12 lakh rupees. Current value is 32,84,693 rupees, XIRR 19.39%. Same tenure comparing with the benchmark index, that is a passive fund, Nifty Small Cap 250 TRA. The investor amount is same, 12 lakhs, whereas the current value is 28 lakhs. There is a huge difference in the period of over the period of 10 years. Say the index has given 16.5% and the Axis Small Cap has given 3% alpha. So this alpha 3%, it's a huge amount in the period of 10 years and more. If it is the 15 years and more period, the tenure, if the depending upon the performance and alpha, the current value, the corpus, it will be much bigger. So it is always better to consider good performing active funds, and if the active funds are monitored and tracked on the annual basis, if it is doing well, and we can see a huge difference in the corpus over the longer period of time. Then coming to the last chart, this is actually a question in most of the investors' mind today, as the market has bottomed out. So the historical data wise, there are signals to that. So this chart says that the history tells that in bear market everything falls, but weaker firms, which are usually more in number, fall deep. So what they say here is, what is the sign that the market has bottomed out historically with the data wise is, if 50% of the Nifty 500 stocks has fallen more than 50%, then there are good buying opportunities. Let's see the present scenario. March 2025, it is 50% of the Nifty 500 stocks is down by 12%. Say in 2008, it more than 50% the stocks fell. That is nearly 50% of the 500 stocks fell. More than 50% is around 89%. That is more than 50%. Say in March 2020, it is around 55%. Again more than 50%. Whereas presently, it is only 12%. So here I am not trying to portray that there will be a much fall in this present scenario. This could be either due to the reason that the DII inflow in the present market is higher when compared to the 2008 crisis or 2020 period. The investor has to take a cautionary approach. They should not be in a hurry deploying all the lump sum, thinking that the market has bottomed out and then start putting their lump sum. What is my opinion is, the investor can stagger to 3 to 6 months period and then deploy their lump sum and plan their lump sum, and the SIPs they can continue. Even this is the time for buying opportunity, even they can develop their SIP. All I am trying to tell here is, portray here is, don't try to time the market. Better to spend time in the market, participate in the market. Over the period of time, definitely we can build a good corpus. With this, I'm coming to the end of our today's content. If you like the content, do hit the like button. If you have not subscribed yet, please do subscribe, and I'll be coming up with another interesting video very soon. Thank you.